Hey everyone, this is John Feneck with the Feneck Commodities Report, and with me today, of course, is Don Durrett. So we're going to talk a little macro here on the front end, and then we're going to bring in John Miniotis, who is CEO of Abra Silver Resource. John's company just put out a 43101 this month, which indicated that they have 258 million ounces of silver in the M&I category. So I wanted to hear more from him on that. It's big news for him. And Don, I don't know where we start today, but obviously it's been a difficult January. You and I last met in December, and with the gold price really kicking it at the end of the year, a lot of people thought we'd have a really good January, but it's been pretty challenging.
I actually didn't expect a good January for gold because the market was so strong. It has been strong since October. It was strong in December. I expected the carryover to January, February, the stock market. So I wasn't expecting anything from gold in January, and I'm not expecting anything in February either.
Okay. And what are you basing that on?
The momentum in the market, the momentum in the stock market, all the bullishness. So the only way that gold is going to break out here, I remember, we had gold in December. All the TA guys were saying it was breaking out. We had gold hit an all-time high, and everyone was thinking carry through. I couldn't believe how many TA guys were calling breakout, and I was like, no way, it's not happening, people. And the reason why it's not happening is because you need a driver. And what was pushing gold was technicals. It was the dollar. The dollar went down to 99.
Yes.
And the dollar falling was gold pushing. It was a total technical rally. And the dollar is stuck in a technical rally right now with, the dollar's at 103 and it's just, and the gold's been falling. And it's just totally trapped in a range here. And until the stock market, we can talk about this, until the stock market rolls over and the economy weakens and we go into recession, that's going to ignite gold. That's when everybody's going to get nervous. I got to own gold. I don't trust these other assets. Gold is always a hedge, and it really hasn't been needed as a hedge since 2008, 2008, 9, 10, somewhere in there. But since, I don't know, 2012, 2013, somewhere in there, gold has not been needed because the Fed has been able to manufacture, growth, total manipulation in the market. And now debt's gotten completely out of control here. And I really feel that we're going into recession, the stock market's going to crash, and gold's going up. And I think that the window opens in March, sometime March, April, May, somewhere in there. I'm expecting the markets to sell off hard, and everybody to basically wake up to the fact that this economy is very, very weak. Everybody thinks it's strong because they're cherry picking the data. They're looking at jobs, and they're looking at income, and they're looking at GDP. Those are really the only thing they're looking at. They're looking at consumer confidence. And my feeling is those are all lagging indicators. It's the leading indicators are actually very, very ugly, in my opinion. And so it's just a matter of time before jobs is always the last thing to fall. And
absolutely.
Jobs is what is holding up income, and it's what's holding up GDP. So when
non-farm payrolls start to dive, that's a good indicator for a sector rotation, perhaps, because we've seen really, I have to say the non-farm payrolls numbers last year in the second half were surprisingly good, and that hasn't helped our sector, right? So.
Right. Yeah, absolutely. I was wrong. I thought that the job market.
What do you think will be the driver?
Yeah. So what I think that the driver is going to be is just the slowing of the economy. Today we've been having more and more announcements of layoffs. We had an announcement of UPS today, which is pretty significant. We had an announcement of PayPal today. So we're slowly getting this degeneration of the economy where we're seeing more and more layoffs. The Russell is a really big indicator, in my opinion. The Russell is not recovered from the 2021 crash. You go back and look at the Russell, which is your small businesses, they have not recovered. You look at the stock market and you think everything is rosy, when in fact, it's only being pushed by technology. All the other sectors have been flat to down. They have not recovered. And so the economy itself, the overall economy itself, in my opinion, is weak. And if you, depending on where you work and what sector you're in, you can't be happy right now. Your cost of living has went up. You're not sure if you're going to get laid off, depending on what sector you're in. Things are weak. Things are not strong. And I think we're headed for a crash here. I mean, if you look at cycles, right? The 4-year cycle, the 8-year cycle. So you go back 2012, 2008 was when we really hit. Then you got 2012, which is kind of when we turned. But in 2016, there was weakness in 2016. And they were trying to raise rates, it didn't work. But gold got hammered in 2016. But it was basically a kind of a cycle. Then you had 2020, and 2020 is when all hell broke loose with COVID. Now we have 2024. We're here again. So the 4-year cycle, I think, is in play. I think it's going to hit. For me, it's really all going to be about momentum. Once things turn south, I think it really turns ugly. So here's what Wall Street is thinking. Wall Street is thinking, yes, we're going to get a correction. And the correction is only going to be shallow. It's going to be like 5%. And it's going to be a necessary correction because things have gotten, we've had this big run since October. We're going to get this shallow correction for 5%, and then it's going to just take off again. Mm-hmm. Well, how does it take off again? All the Fed's going to do is lower rates 25 basis points. Is that really going to be the engine to take it off? I mean, where's this engine coming from? Your turn.
Yeah, I totally agree with you, Don. We saw the Fed start to indicate November 1st that they would get, a little bit more dovish. And then obviously December 13th, things were really dovish because 17 of the 19 members were, open to a cut or multiple cuts, I should say, in this year, 2024. But that number has shifted from maybe 125 basis points worth of cuts to 50 to 75 basis points worth of cuts, in my opinion, right now, because the March 20th meeting is almost, I wouldn't say off the table, but it's a 41% probability of a cut, whereas on December 31st, it was an 81% probability of a 25 bip cut March 20. That has now moved to May 1st. So if you're looking at here January 29th or 30th, well, that's a long way to May 1st. I mean, a lot of this broad market rally could fade, like you say, based on earnings. I mean, you saw Tesla last week got smoked on their announcement. So there's plenty of downside risk here. To your point, like some of these names are really priced for perfection in the broad market.
The overall stock market is not strong. I mean, if you look at like total companies, what their earnings growth is, we're gonna find out. But it's really top heavy. These big caps are really holding this whole thing up. So when they start announcing their earnings and they start earning their projections for this year, I mean, one thing we keep hearing over and over again, this is back heavy, back end. It's like the second half of the year is when things are going to get better, right? And the reason why they're saying that is because the economy is weak right now. So they think it's going to strengthen, and I think it's going to be the exact opposite because usually, historically, whenever the Fed lowers rate, it's usually for a bad reason. They're cutting rates because they need something's breaking. They're not cutting rates because, inflation went away, we're cutting rates, everything's rosy, it's going to regenerate things. So they're anticipating, it's a very contrarian view that and this is where they're contrarian. They're contrarian in the fact that when you have high rates, those high rates have a lag effect. And so the lag effect has to hit. And they're saying, because it hasn't yet, right? We haven't had this lag effect yet. So they're basically saying it's not going to happen, which is, I just don't see that possible, especially when they're not going to cut really aggressively. So if they're not going to cut really aggressively, it's kind of a higher for longer scenario. I mean, we're at, 7% mortgage rates. We're at 8% auto rates. People can't refi Like right now, if people are their cost of living is went up 20-30%, which is a big jump, right? And a lot of families are like, okay, we got some equity in our house, but they don't want to take out a HELOC on that and borrow money against their equity because they're going to have to pay 8% or more, right? So people they can't tap into the money, so they're tapping into their 401ks. They can do that, and their credit card, they hit a wall very quickly, because if you spend money on your credit card bill for a few months in a row, your bill goes up, and you're like, your monthly payment goes up, and you kind of hit a wall, hit a ceiling, right? So the consumer in many respects is hurting right now, and people are mainstream media and Wall Street throwing out the signals that everything's fine. And not only do I think it's not fine, but I think we're headed for a train wreck here. I actually think that this is the year where I consider it a paradigm shift. So if you go back to 2016, that was the year, basically, our political system, when Trump got elected, our political system basically broke. We had this bifurcation where, I mean, it was already bad, right? We had already started seeing this split in the 90s. But 2016, I mean, the bifurcation was real. I mean, it was a complete split politically, right? And both political parties no longer had the same values. That's the key here. I mean, the values literally just completely split apart. Now both parties, I mean, the only thing that they can really agree on is war, supporting the Ukraine war, supporting Israel war, or supporting the budget. That's about the only thing they can agree on, but they basically are diametrically opposed to any economic, their economic policies are just completely separate, their social policies. My point is 2016 was a big year. And not only did our political system break, but our media broke as well. Our mainstream media broke. I mean, CNN and MSNBC, they basically they stopped doing their job. All they did was just do Trump 24/7. It's like, what happened to the news? It just died, right? And then we saw that in all the big newspapers as well. We just basically saw our journalists, our media basically stop. Then in 2020, we had COVID, and we saw basically our institutions break, where we could no longer trust our institutions, the CDC, the FDA. It was amazing what we saw transpire from 2020 to 2024, what's happened to this country, as far as, the border, what's going on the border. Aren't they supposed to do their job kind of thing? It's like, things got crazy. I mean, people think, things went nuts, crazy, 2016, 2020, 2024. I'm getting on this 4-year cycle thing. So now at 2024, in my opinion, this is when the economy breaks. So our political system stopped working, our mainstream media stopped working, our institutions stopped working, and now our economy is going to stop working. This is the paradigm shift. And it's all leading to the reason why I got into gold, which is the bond market breaking. The bond market is already starting, we're seeing cracks in it. We saw it in September and October. The bond market, we're seeing this de-dollarization with the global south starting to pick up steam. And that's all related to basically what I'm talking about, because the dollar, the dependence on the dollar, the dependence on bonds, on us being able to sell bonds to foreigners is very important. And when that starts to crack, that's when gold goes to the moon. So for me, the only thing that really matters to me as far as gold goes is the bond market. Now, the bond market is not just government bonds, it's also corporate bonds and state and muni bonds as well, the whole entire bond market. I know the stock market's going down. To me, that's totally done deal. We know that's going to happen, in my opinion, because of the economy weakening. But what's the wild card, which people aren't expecting, is the bond market to go down with the stock market. We're already seeing that with the TLT going down from 160 down to like 85. So it's already starting. But what hasn't started yet, and what's coming and what's going to push gold to the moon, is this idea that bonds are actually risk on assets, and they're not risk off assets. And that's going to be the paradigm shift. That's the hot potato when basically people are dumping their bonds going, I don't want these stinking bonds. They're going to be like junk bonds. U.S. bonds are going to be turned into junk bonds, basically. It won't happen overnight. It'll happen slowly, but on the margin, it'll start first on the margin, but that's all it takes. It'll be a trend, if you will, and then the bond market will slowly, like I said, become kind of a risk-on area. All of them, all bonds, corporate, government, muni, they'll all become basically risk-on bonds where, am I going to get my capital back? Are these smart? Is this a smart play? So that's the way I'm looking at this year.
Yeah, excellent analysis. And just for clarification, Don and I look at the TLT, which is an ETF out there, which tracks the 20-year, longer dated bonds. And many people from my community and in the financial advisor community will construct portfolios for clients that consist of a lot of bonds, right? If you're a retiree, you're going to have a 60-40 portfolio many, many times if you're in your 60s into your 70s. And yeah, the market was awesome last year. That 60% probably did quite well for you, but that 40% did not perform well at all, and the chart still doesn't look good. So that is part of that's what we call the difference between investor performance and investment performance, right? Like investment performance is great. It's on the screen. It's like, oh wow, look at the market, how well it did last year. But what was your investment performance, right? It's different because you're not going to just throw your money at the NASDAQ or the Magnificent Seven and call it a day if you're a retiree. You just can't take that risk.
Yeah, absolutely. And bonds have always been considered safe. And I always knew that our strategy, our economic strategy, was basically, it was non-tenable. It was this idea that debts, we can always pay back our debt, we can always expand our debt, it's never going to be a problem, we can always deal with it. That mentality. And I think it started in the 80s. And it was just a matter of time, and we're there now. It was just a matter of time before basically the printer breaks, where you cannot just print at will. You can't just print whatever you need. And in 2020 was a perfect example where we printed, like $4 trillion, probably more than that when you bring in the Fed's balance sheet. We printed it because we could, basically. But we're reaching a point where now we're going to need to do that again. Maybe 4 more trillion, maybe 6, maybe 8. At a certain point, it becomes untenable where you can't do that, because if you do it, it's just going to create so many, blowback. The blowback effect it'll be more costly, if you will. That's my expectation. They'll have to think twice. They won't just say, okay, let's just print, $2 trillion this month. Like, wait a minute, if we do that, what's the blowback's going to be too harsh. The dollar is going to basically go down another, significantly, and interest rates are going to go up, and we can't afford it. Our interest bills at, let's say, 1.5 trillion. If we do this, it's going to go to 2 trillion, right? And so that's what I mean by the blowback, is that interest rates will go to the moon, and then the dollar will basically disintegrate. Standard of living, the cost of living will go up, and is going to bankrupt, everyone. The middle class, the lower class, and the government and corporations, just bankrupt everybody. That's kind of what debt does.
Isn't it wild though that as you say that, I know you're just using that as a loose term, it'll bankrupt everyone. I'm not putting words in your mouth, but let's just say, literally, the investment community has less than 1% in our sector, collectively in the US. There's not even close to 1% in things like Newmont or GLD or anything. It's like this is a risk on market like I've never seen before. It's just, I think people need to get burned that are taking this extreme risk right now to get to get taught a lesson, because if you're not paying attention to things like credit card debt at an all-time high, things like, you know, auto loans defaulting at an all-time high, like these are warning signs. And you have to be able, I've been saying this for the last 3 to 6 months on every podcast, you have to take some money off the table here. I don't know where that is for you as an investor, but you've got to be more conservative going into a year like this, where this is the 15th year. March will mark the year 15 that we're going into a bull run here in the broad market. Like, that's insane. It's never happened before. So, you know, with that, Don, I want to pivot to 2 quick things before we bring on AbraSilver. Go ahead, Don.
Yeah, before we pivot, I actually want to say something about what you're talking about opportunity, about only 1% in gold. So I was watching the movie Dumb Money last night about GameStop on Netflix. And I mean, the one thing that really hit home to me was how people were buying GameStop to make money. It was all about opportunity. So it was amazing on how many people, and they were showing, it was a diverse group of people that were buying this GameStop. But the reason why they were buying it is because it was in the news and it was trending up. And it was like, oh, wow, it's like easy money kind of thing. I'm gonna jump on the train. Mm-hmm. And my point was, I was thinking about this, is like, once gold and silver finally start to trend upward, for instance, I really feel if you look at the silver chart, once we get to like $27, maybe 28, once we get there, once we get above a certain level, the technicals basically take over. And the technicals, basically you'll get a magnet to 30. And then once you get to 30, it's like, oh my God. I mean, the technicals really improve. Then you get basically a magnet to 35. And it won't take long to go from 27 to 30 and then from 30 to 35, because there's just nothing stopping it. And so, and then once you get to 35, I feel that it's like the momentum is just there's just gonna be so much momentum there. Like, there's nothing to stop it from going 35 to 50. So it's been to 50 twice. It was at $49 in 1980. It was at $49 in 2011. So you have these 2 big runs, fast runs from 35 to 50 twice. So the same thing will happen the third time. So you're basically going to run from 27, 28 to 50 in less than 6 months. Now, during that 6-month period, you're going to have stocks going up 100% in weeks. You know.
Oh, I mean, some of these juniors could go up that amount in a matter of a couple of weeks, because honestly, they're so beaten up right now. I mean, you know, that leads us kind of to our next point, on before we have 5 minutes before we bring John on. I wanted to touch on that SILJ rebal, because a company had purchased SILJ, which is of course the micro to small cap, if you will, silver ETF out there for equities. That occurred on Friday, and then this Monday, the 29th, all hell broke loose in a bunch of names, including AbraSilver, which we're about to talk to. Some of these names are down, you know, 15 to 20% in one day, because again, I've said this coming from the ETF world, someone who's in charge of a rebal doesn't necessarily understand silver stocks just because they own the ETF, right? Like, they're taking on assets under management. If you look at all the other ETFs they brought on, it had nothing to do with gold or silver. So you're putting those same traders on these stocks thinking, okay, we got this under control. And then you realize there's no liquidity in some of these names and you cause havoc. And so, Don, what is your take on this?
Yeah, I have a few opinions here. Well, first of all, I do own SILJ, and mainly for diversification. I don't like to have big allocations in individual stocks, but with ETFs, you can have big allocation because they're not going to go bankrupt. So I like them for diversification reasons. I won't sell my SILJ until silver gets to $100. That's my kind of investment strategy around SILJ. Now, I will say this. I've never been a fan of their management team, their company, if you will. SIL, I'm much more comfortable with. SILJ, it's like, you know, it's like a kind of a small company with not a ton of experience who basically saw the opportunity to create a silver ETF and jumped in, right? I would much rather it be some company that, had been around for 20 years and knew what they were doing. And today, and the rebalance is a good example of this. I mean, it doesn't shock me. The one thing, there are a couple of things about the SILJ. It really frustrates me to no end that they have so many gold miners in there.
Yep.
I mean, you call it SILJ when, GDXJ has a lot of silver miners in it as well. And it's not really a silver junior. It's really a gold and silver junior, and that frustrates me. I think they own too many gold miners. They don't need to per se. There's plenty they can own the entire silver, all of the silver miners, right? And to just take small positions in them and their allocations. Now, so I don't like the way they allocate. So I like the SIL better, if you were, as ETF, if you will. But the SILJ will probably outperform it. Because they have a lot more juniors, let's say. Now, I was very frustrated that they deleted so many kind of strong names. It's like, why would you just dump, some of these companies? Right. Discovery Silver is probably my favorite silver development play. Why would they just dump it and then it drops 20%? I mean, it's just ridiculous. Ridiculous why they do that. I mean, where's the big weakness there? I mean, do they have insider information regarding permit problems or something? Because
I seriously doubt it.
Discovery, this is a big year for Discovery. I mean, their stocks will probably go up 100, 200% this year, and it probably will. And here they
took it down from. I looked at that today. It took that's DSVSF. It took it down from 49 and change to 43 and change in one day.
Oh, okay. Well, I actually showed where it's actually showed deleted. I didn't see it. They only took that much out of it. Well, if they took it from 49 bips to 43 bips, and that really shouldn't have drove it down 20%, right? But
no, sorry, Don. I meant 49 cents price to 43 cents price. I think you're correct. They did delete it. They deleted some gold names as well, but I don't know what their methodology was. I haven't been able to find time today to call the company to see what that is. But usually with these ETFs, they're not going to give you too much transparency as to what their process was.
All right, so they did delete it. So, and they deleted Klondike, which is just a really nice optionality play. I mean, they got a ton of silver in the ground. They're drilling Columba. It's like, why would you delete a company like that? I mean, just the silver in the ground is worth more than its valuation. Why would you just delete it? It makes no sense. But again, like I said, I've always kind of questioned that management team. I hope whoever is running that got fired over this, because they did just a terrible job of rebalancing. And then, what in the world are they doing giving a base metals company the highest allocation in the fund, Buenaventura? It just makes zero sense. I mean, right. It shouldn't even be in the fund, and it's got the highest value, highest one. And then they got gold royalty companies in there. Come on, man.
Yeah, I know. It's really bizarre. And we don't, as an industry, we don't need that. It's like the ETF world is a way for investors to play a sector, any sector, easily, but it's not really optimal. If you look at something like GDXJ, not to go after that, but look at a 3, a 5, a 7-year chart, you pick the time frame, you would not want to be holding that if you didn't know what it was, right? If I just showed you the performance, you'd say, well, why would I want to own that? That's the problem with that's one of the problems with our industry, Don, is that these rebalances get done, and Feneck or this new company, they're not going to show you their hand and tell you necessarily what their methodology is. But then you just look at the performance over long periods of time and you say, well, this has been pretty bad. I mean, honestly, it is. If you look at, your performance, look at my performance. I publish it publicly on my website, feneckconsulting.com. It's out there for 8 years. We're trouncing GDXJ over periods of time. It's not through luck. It's through hard work and calling CEOs and doing the work. Like that's how you beat these ETFs. But when you do it like they just did it, it makes it even easier to beat the ETFs because there's no mindfulness. You know what I mean?
All right.
It's maddening, but let's pause there and bring on John Miniotis. John, if you're available. Hey.
Hi, gentlemen. How are you? Thanks very much for having me.
Yeah, of
Good to speak with
course.
you.
Yeah, we'd love to get a 8 to 10 minute kind of overview from you on what's happening. Obviously, I saw the January news with your JV with Tech, and also with the 43101 on the main project there. So let's just jump right in.
Okay, perfect. Yeah, let me just share my screen here then. I have a couple slides. I'll walk you through, again, just a high level overview of the company, and then happy to open it up here to Q&A. So AbraSilver, our key asset, of course, is Diablillos. So we're a high growth silver and gold explorer. Diablillos is located in a very mining friendly province in Argentina. This is the Salta province. And Diablillos is quite an advanced stage project already. So we just updated our resource estimate back in November, so a few months ago now. This is all located close to surface in oxides, open pittable mineralization here. And so far, we already have close to 150 million ounces of silver in the ground and just over 1.4 million ounces of gold. And that's all, again, in the measured and indicated category. So we're not including any inferred here. So a nice sizable deposit, which has really grown significantly over the last few years. And what's really exciting for us is we're not just increasing the scale here, we've really improved the quality. So last year, we found this new high-grade extension to the main deposit. This is what we call the Jack zone or the Jack deposit. And you can see much higher grades here. So Jack has really emerged here as the highest grade mineralization and really helps bolster the economics. We'll be coming out with a pre-feasibility study very shortly here. So within the next few weeks, we should have that announced. And so we'll be able to wrap around the NPV, the IRR, all sorts of rates of return here once that pre-feasibility study is out. But in terms of next steps for us, it's really remaining focused on exploration. That's our forte. We have a very, very strong exploration team. You can see their track record over the last few years. I mean, we've added for every 11 cents we've spent on exploration, we've added an ounce of silver in the ground in measured and indicated. And so we have a number of exploration targets here. And so later this year, we expect to recommence drilling and continuing to systematically grow this project and bring it into a production decision by the end of next year, really.
Okay.
Now, importantly, we're located right in the heart of the mining area here in Salta. And so we're right in the heart of the lithium triangle. So Salta is known for lithium. Lithium, of course, had a big boom a couple of years ago now. And there's 4 major projects being built all around us. And so we're going to clearly be net beneficiaries of the infrastructure here. So they've already there's already a highway that goes straight to site from the city of Salta, which is a large city there. There's already a natural gas pipeline, a second natural gas pipeline is being built. There's an airstrip at these projects here, sufficient water as well. We have the water availability for up to a 9,000 ton per day operation. So we're really, greatly located in a very, very mining friendly part of Argentina. And then we can talk about Argentina on the federal side as well shortly, with Javier Milei coming in just recently, looking to significantly deregulate and open up the Argentinian economy. Some of the reforms he's proposing here would have significant transformational, I'd say, game-changing impacts on the economics here for not just our project, but I'd say most projects out there in Argentina. So a lot going on in Argentina here. We're very happy with the way Salta has progressed, and most recently Argentina is clearly moving in the right direction, and they're clearly open for business and looking to encourage mining investments in particular. Now, this is what the project looks like at surface from now. So this is the main Oculto deposit. You can see again, for open pit standpoint, this is this is ideal. So it's high elevation, about 4,200 meters elevation, but there's very little snowfall here. So it's a dry desert-like environment. There's no vegetation. There's zero alternative land use here. The nearest community is a 2-hour drive to the north. So from a permitting standpoint, this is great. And this is a 3D rendering, what the project will ultimately look like here once we start mining. So the Kulto deposit, we had economics on this, which we published 2 years ago. It already had a 30% after-tax IRR and about a $500 million Canadian net present value. And that was just based on $24 silver and $16.50 gold. And so obviously gold's increased there. Silver's right around in the same ballpark. But now with the discovery again of this high grade jack zone, this really gives us excellent optionality. So this is located closer to surface than a Kulto, which so it's cheaper to mine, even less overburden, but importantly, much higher grade as well. So 200 grams of silver on average here with 5 million tons. And so this is a game-changing discovery for our company. This will start mining from this jack zone. This could, feed the plant for the first 2 years or so, really help get a very rapid payback, and then you start mining a Kulto. But what's really exciting is the exploration upside that still exists, and I'll just talk about that. This has, significant room to continue to grow here. And just quickly, once again, I mean, since myself and my management team here took over running the company back in December of 2019, you can see the job the exploration team has done at site. So I've really done a phenomenal job here, consistently growing this with every drill campaign. We've just completed our 3rd drill campaign. This was a phase 3 program. And you can see, I mean, we're achieving growth here between 20 to 35% annual growth here. But what's important is we're doing this on a very, very cost-efficient basis. And that's the key, especially in this market where it's obviously difficult market environment right now for all explorers. You want to be preserving your cash position as well. And so we're doing, I think, a very good job here, gradually deploying capital, but achieving significant rates of return on every exploration dollar that we spend. And this shows you some of the, the achievements again from the team over the last 3 years. If you look at all of the highest grade silver intercepts in the world, so it's not just in Argentina, not even just in South America, this for every primary silver asset, whether in production or a project globally. If you look at the, the rates of return here on a grade thickness basis, so these are the 13 highest grade intercepts. We have 6 of the 13. And so our team, again, has, I think, done a great job here through the drill bit, growing this. And what really stands out is that we're, hitting some very, very high grade intervals. But again, this is in oxides close to surface. And so that really stands out because you can get these thick intercepts. So you can see 155 meter intercepts, 140 meter intercepts of very, very good grades. And so that makes it very efficient to mine as well, because you're using, open pit, which is a bulk mining method here, much lower cost. And so this is ideal. Now, just quickly, I don't want to get into too much detail here. There's a mag map, but you can see some of the other zones. The way we discovered this new jack zone here was this magnetic low anomaly. This is the purple anomaly. There were several other magnetic low zones with similar geological characteristics, which we have yet to fully drill. So we've only drilled a couple holes in each of these. We prioritized jack because it was the closest to the main pit. We've drilled that out, had great success. Now this year, we'll be looking to drill out these other zones, and again, could have a significant, could see significant growth, I'd say, in the overall resource here. Now, what's important, just to mention again, it's not just growing the resource. We already had a 16-year mine life in the PA. If we were just adding low-grade ounces that you tack on at the end of the mine life, we're honestly we wouldn't be adding any value there. So what you want is to increase the size of the resource, but importantly, bring higher grade mineralization, discover higher grade mineralization, which is going to be processed right up front. And that's what we did. So if you compare this to on a gold equivalent basis, you can see we have over 3.2 million ounces gold equivalent, and the grades here are approaching 2 grams per ton in oxides, open pitable. So really stands out. I mean, where you want to be on the scale, of course, is right on the top right-hand side. That's the trajectory where we're moving. And we think with the next exploration campaign, the goal would be to get to close to 3.5 million ounces here. and get to 2 grams per ton with some of these high grade deposits that we have yet to drill out. So that's really it. I mean, that's our key deposit. Just 2 seconds, touch about our secondary asset. We're quite proud of the deal we were able to announce here with Teck Resources just recently. This is our secondary project, a large copper porphyry. This is a large early stage sort of, it's a large land package really, with multiple exploration targets here. We brought in the expertise of Teck. We announced this deal just very recently as a partner, so they can earn up to 80% interest in this by spending $20 million drilling this, making payments to us, $3 million, and then paying the underlying project, option holders over $6 million. So they would essentially spend close to $30 million to earn an 80% interest in this, and we would be left with our minority 20% interest here without having to deploy any cash to this project. So we're obviously, this is in now in capable hands with Teck here coming in and looking to start drilling here very, very shortly, I would say. So that's it. That's it in a nutshell. I mean, happy to answer any questions, John or Don.
You want to go first, John?
Yeah, sure. John, you mentioned about open pit, and from looking globally, like there's not too many open pittable projects that come to mind with this many ounces. Right. Am I off base or?
That's right. So in terms of primary silver projects, there are a few, but certainly not at these grades. And so these grades make it really stand out. And so there are larger silver projects out there that would literally have a fraction of the grades here. And so at Jack, we have 200 grams per ton of silver. It's always easiest for, I think, most investors to think of this in terms of gold equivalent. So the economics here would be about 60% silver, 40% gold. So this is entirely 100% precious metals. So it's not like we're adding zinc and lead or any of this to skew sort of the outlook here. This is 100% precious metals. There's a lot more gold, primary gold open pittable oxide projects out there. And that's why we show this graphic here. So this shows all the sort of, open, not all of them, but the vast majority, I'd say, of the open pittable gold assets out there, whether in development, which are darker blue here, or actually in production. And there are a number of those on this graphic as well in Latin America. And again, you can see that we stand out by size, having over 3 million ounces gold equivalent, but the grades were right up there among the highest grades. If we were to show this in terms of silver, there'd be probably 2 other benchmarks with projects, certainly much more ounces. There's projects out there with, a significantly higher number of ounces, but at a fraction of the grade. And so, I think we stand out because we're a high quality. We're not, we don't need $50, $30 silver to make this work. This is an economic project at today's silver's environment. Obviously, if you get that boost in silver price, there's huge leverage here to the upside. So you'll be printing cash flow at much higher silver prices here. But this is a project that really stands out because of the scale and the grade.
Okay, and I just wanted to ask a follow-up and kind of make a statement. The statement would be the price action yesterday in the stock was all over the map, and that was, Don and I were just talking about the SILJ rebalance. AbraSilver was affected by that. Have you gotten any, feedback from them as to why this occurred, or like anything you've seen from any of these shops that have put anything out, like Canaccord or BMO?
Yeah. So it's a passive ETF, and so for them, I understand there's a new owner that took over running that fund as of yesterday, and now apparently they're resetting to a different benchmark, and okay. I believe AbraSilver is no longer on that benchmark. So they significantly reduced their holding in us. I mean, but this has been the case, for many, many quarters now. Every quarter, the SILJ has this radical rebalancing process where they literally sell millions or buy. I mean, sometimes it works in your favor, but it's very, very short-lived. And so it creates huge liquidity issues here. I mean, they're literally, I think yesterday, sold 5 million shares in the last 10 minutes of trading. I mean, they literally start selling at 3:50 p.m. Eastern time, and the market closes at 4. And then I think they go into the extended hours and sell until 4:10 or something like that. I mean, yeah, it's to me, it's completely amateurish, the way these rebalancings are consistently done. Hopefully, there's going to be some significant changes here. It creates huge volatility. So yeah, we were down quite a bit yesterday on the news. We essentially fully recovered today. And again, today, I think it was just organic buying. I don't think the ETF clearly wasn't buying if we're no longer in that benchmark. So natural buyers stepped up. But again, I think we had over 6 million shares traded. So people saw the opportunity. We were depressed. And obviously, the market is somewhat efficient. I mean, you sort of correct. And I think for the guys yesterday that were up 20% on the SILJ buying in the last 10 minutes, I think all of those were down significantly today. So, just creates huge amount of noise and distortion. And yeah, I'm not a fan at all of the SILJ. And hopefully this can't continue. I mean, it's not good for anyone other than, traders or these algorithms that could trade within seconds. Obviously, these price swings would be great for them. But for long-term investors, obviously, nothing's changed, absolutely nothing. They don't reach out. They don't probably know anything about any of these companies, I would say. And so it's a passive fund, and they're just relocating some of their positions to track a new benchmark, and obviously had some very aggressive buying and selling because of that.
I remember when that happened with Feneck and GDXJ. I think it was 2016 or 17, and they actually gave people many weeks of advance notice that this rebound was coming, but this one was like quick. So thanks a lot for your comments on that. I just wanted to give you the opportunity to talk about it. And lastly, before I turn it over to you, Don, you had mentioned about your pre-feasibility, your PFS coming here. Is that in February and or March, somewhere in this time frame?
Sure. Yeah, we're putting the final touches on that right now. So within the next several weeks. So likely end of February, I would say, sort of time frame there. So yeah, that's coming together very, very nicely. And again, obviously, once that's announced, we'll be able to discuss that in as much detail as you'd like.
Great. Thank you, John. Don?
Yeah. So John, I won't put pressure on you trying to ask you questions about what's going to be in the PFS. I'll give you so a couple comments. First of all, the ETFs. I actually think that's going to be very positive for your company because as you advance, there's not that many quality silver projects out there, right? So you're going to be pushed into these ETFs like SIL, GDXJ. So the ETFs are actually going to be very beneficial for you.
I agree. So I have no problem with ETFs in general. ETFs are great. I mean, SILJ, it's this rebalancing that happens, there must be a better way. I'm not familiar with any other ETF that has such radical, rebalances that occur every quarter, essentially. This was an intra-quarter one because there was a change of ownership. Right. So yeah, fully a fan of ETFs. I understand, of course, there's a natural buyers there as we get bigger. As we get into more ETFs, that's very, very positive. But yeah, we prefer not to have 10 million shares traded in 2 minutes because that doesn't help anyone here.
Right. Well, one way the ETFs work is that as more money, let's just use like GDXJ as an example, as more money goes into, people buy the ETF, if you will, more money goes in, they actually buy more shares of the companies that are in the ETF. So if you're in the ETF, you benefit, right? And so the quality companies, as long as you're performing, let's say you've got a 1%, allocation in GDXJ, as long as you're performing quarter to quarter, as the ETF grows in size, you benefit. They buy your shares. I wanted to point that out. The other thing I wanted to point out before I begin asking questions is that, in my opinion, silver is going to go up 5x from where it's at now, say 23 to over $100, and let's just say 100, that'd be 4x. And gold is only going to go up 50% from 2,000 to 3,000. In other words, silver is going to outperform gold by a big, big margin, right? So looking at your screenshot right here, you're showing yourself as a gold miner, 3.2 million ounce gold equivalent. I think you should use that to your advantage. That's as silver explodes in value, you're going to benefit big time from that. I think you should point that out. So you're, in many respects, you're a silver mine, in my opinion.
Of course. Yeah. And so as our name, I mean, it's clearly AbraSilver. I mean, we're focused on silver. So silver is the dominant commodity here. And so, we have this chart that we use in our corporate presentation. We show this, of course, at 260 million ounces silver equivalent, and compare that to the mid-tier silver producers out there. So these are all producers from First Majestic, Endeavor, Fortuna, et cetera, down the list. And so, this is a standout primary silver project with a nice gold component, 1.4 million ounces of gold, of course. And so, everything we do, all our press releases is always on a silver equivalent basis. And so that, the problem is, again, there's a scarcity of open pitable silver oxide projects. And so if we want to start comparing the grades here, what we don't want to do is compare our grades, which is open pitable and oxides, to the vast majority of silver projects out there, which are underground in sulfides, because you're comparing apples to oranges. I mean, you can't, if something's 1,000 meters deep and, these two meter veins versus ours is close to surface. And so, I think that's why the most accurate, when you're comparing grades, at that stage, it's accurate to compare it to other comparables, which are gold, open pit, in oxides, because there's just a lot more comps out there. But you're 100% correct, and we feel very strongly in the silver price appreciation, and you'll see. I mean, again, in our press releases, in our presentations, everything's always expressed in a million ounces of silver or silver equivalent.
All right. Well, in addition, one thing that you can do, just to show people, because a lot of companies don't do this, they just stick with silver equivalent and kind of ignore the idea. Some companies do, some companies don't, but to ignore the idea that it's basically a silver mine, and you could actually present it in that way and then use gold as offsets and basically say our cash cost as, byproduct is, $5, an ounce. So that there's not very many silver producers today. There's only, I think, 14 silver producers. And these are actually not pure silver producers. They actually produce gold and silver. 14 with a market cap over $100 million. So once you're in production, you'll actually be the 15th. Well, it depends. There'll probably be more that join the crowd.
Sure.
But it's a small club. So of those 15 silver miners, only about 3 of them are actually low cost. So you'd be joining that club. Mm-hmm. And so that's my point, is that if you just show people, look, we're basically we have a low cost silver mine here. I mean, if you can produce 8 million ounces of silver a year with cash cost at $5, and let's say silver goes to 50, your free cash flow is actually going to be kind of insane. So my first question to you is, when do you think your permits, are you working on permitting right now? Yes. And when will the permitting be completed?
Yes. Yeah. So we'll be submitting the EIA. So that's the overarching permit to the SALTA authorities as soon as essentially the pre-feasibility study is complete. And so the pre-feasibility study is, again, by the end of February, so within the next few weeks here. And the EIA application is essentially, again, just being reviewed right now. It's essentially finalized, but undergoing a review. And then, of course, we have to incorporate the pre-feasibility study economics into that as well. And so, I'd say by March or so, end of March, early April, expect to submit the EIA application. And that's only to the provincial authorities. And so that's one of the great parts about Argentina is the federal authorities have no say whatsoever in terms of permitting. So SALTA is quite known, well known, I'd say, as having a quick, efficient sort of permitting process. And again, going back to that slide here, where I showed you all of the lithium projects nearby that have been permitted, that have now been constructed all around us, literally within 30-kilometer radius. Fortuna Silver is a gold heap leach mine. That's Lindero. That was permitted quite rapidly as well. So we expect to have the permits in place by the end of 2025. So we'd be submitting those shortly. By the end of 2025, we'd have permits in place. We'd also have a bankable feasibility study in place by that same time period, by the end of 2025. And so then pending a financing, a final pending financing, this would be a construction ready project, essentially, that would be ready to be constructed. And yeah, happy to talk about that. There's a lot of optionality here for a company of our size to continue to even develop this.
Yeah, so I've been analyzing companies like yours for like 20 years. And one of the things that I've learned over that period of time is to get excited about companies that basically check all the boxes, if you will. And your company really, I mean, there's two boxes that I really want to see checked that, you know, kind of give me heartburn. I am a shareholder, but I want to see it. No, so one of these boxes is guidance. It's like, okay, and you're giving us really good guidance right now. I mean, you're basically telling us, look, we're gonna got a PFS coming out probably in February, March. We're gonna work on permits. Permitting should be completed by 2025. We should be construction ready. I mean, this is the kind of guidance that I really look for. But what I really want to see is to gets me, you know, investors really excited. Is I want to see in your company presentation that guidance, you know, on a chart, on a flow chart, the dates, you know, that say, okay, this is what we're going to do. The fees on this date, you know, construction ready on this date. You know, work on financing. Yeah, this right here. This is the kind of stuff I want to see.
Yeah.
Correct. Yeah.
And then one other bullet point, like at the end of 2025. Really, I want to see a company that basically they have a plan. We're carrying it out. So the two things that aren't on here. One is the construction decision date and basically the build. I actually want you to show me the build's going to go from here to here. First pour is here, right? It's like this is our plan, right? I want to see that plan, and that's the one thing that I really would want you guys to highlight more and more. The other box that I don't feel is checked is your insiders. Now I have your insiders at 24%, which is Eric Sprott, of course, is 12. I have management at 3. That includes the board, and then I have SSR Mining at 9. Are those numbers correct? That 24?
Yeah, no. The SSR would have been outdated. So SSR would have sold their shares. So that would have been back when SSR spun off this project. I think that was in 2016, and so that was to our predecessor company. And again, myself, the current management team, we took over in 2019. But yeah, I believe SSR was diluted but below 9%. And I'm not familiar if they still own those shares. And so, yeah, the SSR number hasn't been verified because it's, 5 years out of date or so. But yeah, the other numbers, Eric Sprott is still at 12. Management's, I believe, about 4%. And we have, again, an extremely lean management team. That's essentially myself, our chief geologist, and the board, and a couple members on the board. So collectively, I mean, it combines to 4% in total shares, but as a portion of our individual net worths, like for me, I own 5.7 million shares, plus I have a few million options on top of that. I mean, this is 95% of my net worth here. So it's a huge amount of skin in the game. And that's the case for as well, our chief geologist and for the board members here. And so, yeah, the shares are in very tight hands. And we're fully incentivized with shareholders, I would say.
I don't know if this is public knowledge or if you want to share, but I think I can ask the question. Can you tell us your average cost basis personally?
Yeah, well, yeah, of course. Everything's filed on SETI. So you can go and look at every transaction. I have to report, as all
Well,
executives, all insiders do.
What's your ballpark
The
cost basis?
13 cents a share, I'm guessing, 15 cents a share, something like that, Canadian.
Okay.
Yeah.
And it's currently at 43. So you're actually
no, that was Canadian. So we're currently at 29 cents today.
Okay, so you're only a one bagger so far.
Exactly.
All right. So now, as far as valuations go, you're currently valued about 50 cents a share. And if I just give, really conservative cost estimates, let's say I'm looking, because you're not going to be in production for a while. So if I basically use a break even of $25 and silver at 50, so basically your free cash flow is going to be $25 an ounce. And I do 10 million ounces a year. Now, you might not do 10 million ounces in phase one, but you will get to 10, I believe. So at 10 million ounces, that's 250 million in free cash flow at $50 silver. Now, I think $50 silver is a very conservative number. I use even higher numbers than that. So if we use an 8x multiple, it takes you to $2 billion valuation, if you build it. Then if I remove 25% for basically dilution to build a mine, it's basically come to 1.5 billion. Now you're currently valued at 134 fully diluted. So it's basically a 10x return. If you build the mine, it's basically a 10x return at $50 silver. Now, as a shareholder, as a big shareholder, if you sold it before you got to first pour, so let's say you get to first pour and silver's at $50, you're basically going to be a 10x return over the next, say, 2 to 3 years. Let's say 3. Takes you 24, 25, and then we 1 year build, so 26. So 3 years, you basically get a 10x return, or you wait and you sell, and maybe you get $2 an ounce. It's currently at 50 cents. So at $2 an ounce, all you're basically getting is a 2x return. So it's 2x return versus a 10x return. Sure. How do you justify to shareholders like me that 2x return made sense when I could add 10x?
Sure. No, 100%. And so, I think the Jack discovery has really given us now a lot of optionality. Like I just mentioned, my entire net worth essentially is in this company. I have absolutely every incentive to get a 10x instead of a 2x. Why would anybody want a 2x? So management's very much completely 100% aligned with shareholders here, looking for the highest rate of return, of course, on a risk-adjusted basis. So we're going to risk adjust that. But really, this has changed, I'd say, in the last year with the discovery of this new high-grade Jack zone, which again is much closer to surface, and with some of the heap leach test work that we're doing right now. There is a path forward here for a junior like ourselves to graduate and essentially start construction here down the road at the right time. And so what's great about Jack and what's great about the heap leach test work that we're finalizing right now, essentially there's about 40 million tons of what we've characterized as waste and will be characterized as waste in the pre-feasibility study, but has about 0.3% or 0.3 grams of gold here. And it could be heap leachable. And so again, this is in oxides, lower grade gold, but you're going to have to move this mineralization anyways, either place it on a waste dump or place it on a heap leach pad. And so if you don't have to build a plant, we expect our CapEx, again, I can't give guidance because the pre-feasibility study is going to be coming out shortly. But, roughly, if you benchmark this to other projects with the 9,000 ton per day plant, you'll be looking at about 350 million US CapEx or so. So in that general ballpark. And so, that's a large CapEx for a company of our size currently. Obviously, if silver's at $50 and we're a multi-billion-dollar company, then that's not a huge CapEx figure. But just based on the current valuation, we could start off as a gold heap leach producer here, which you could build for a fraction of that CapEx, start producing some cash flow, and then start mining out this high grade Jack zone. And again, because Jack's so high grade and it's so close to surface, instead of building a 9,000 ton per day plant right out of the gate, you could build a 3,000 ton per day plant. Start selectively mining out Jack. Jack would then have a 6-year mine life or so and would be generating excellent free cash flows. And Jack's pure silver, and it's 200 grams.
Yeah,
so pure high grade silver. And so that's the path forward here. And so we could you start off by heap leaching, so you don't even need a plant. You generate some cash flow. Then you start mining out this high grade Jack zone, producing significant free cash flow. And then, of course, you eventually get up to what you would see here, a 9,000 ton per day plant. This would have capacity for north of 15 million ounces a year of silver equivalent. So this is obviously large scale. But yeah, you can gradually work your way up. And so, yeah, we have every incentive out there to continue to, continue to de-risk this project, advance it, and generate as much value as possible for shareholders.
Right. Yeah, at 9,000 tons per day at 150 grams, it's 15 million a year. So 15 million AGQ. I mean, you don't need to start. That's a huge mine. I mean,
That's a huge mine, exactly.
Yeah, you can start at 10, and that's plenty big enough, right? And
Correct.
then 3 years later, add another, slowly, then grow organically. I mean,
Correct.
yeah, absolutely. So how do your insiders, like right now you have Eric's brought 12, management 16. I mean, if somebody comes and tries to buy you out right now, I mean, how do you fend them off? Do you have any other strategic shareholders that are going to vote no?
Well, a large number of institutional investors. They're not insiders, but yeah, I'd say, again, every shareholder is in it for themselves. They're looking to maximize the rate of return. I think all our large shareholders see the longer term value proposition here. But yeah, in terms of when we sign confidentiality agreements, so most companies that are interested would look to sign a confidentiality agreement. We always have a standstill clause in place. So that's crucial. So it's a company can't come in, look at our data room, get all this data, and then go and make a hostile acquisition. So it'd have to only be a friendly acquisition. And so again, once you have a standstill, essentially, the companies have agreed that would only be on friendly terms. And so, yeah, if the terms are great, obviously we have a fiduciary duty to take that to shareholders. But at the current price levels, I mean, we're not even thinking about looking for a buyer here.
Yeah, I got you. Absolutely, I got you. However, I've rarely seen an undervalued project, and you become undervalued at about $30 silver, 30, especially 35. Once we get to $35 silver, you become highly undervalued. I rarely see an undervalued company. When I say undervalued, I'm talking 10x return or better.
Sure.
I rarely see an undervalued company. There's a single project like yours that's in development that does not have strong insiders make it to first pour. 90% of the time they get taken out. And the reason why they get taken out is you just can't stop them, because the institutions, they don't care about long-term results. They only care about next quarter or this year. They literally could care less about long-term results. So if an institution goes in there and somebody comes and makes a 40% premium offer, they're going to vote yes every time. And that's why I think John could concur with me. Rarely do you see offers get turned down unless there's strategic investors in there that basically don't want it to happen. That's why I asked you, do you have any other strategic investors? If you can get to 30, for me, about 30% is kind of key. You're at 16. I mean, you should be out there looking for strategic investors to basically to avoid getting taken out. Basically, what's going to happen is your company is going to get stolen from you. They're going to pay you.
Sure.
You're going to get a chunk of money, of course, but you're not going to get your 10x return on your 5 million shares. You can hold on to them depending on who buys it, right? But if a company like, well, Hecla, actually all the silver companies have pretty big returns. Even Hecla's like a 5x or higher. So right now, but by the time Hecla buys you, like let's silver's at $35, Hecla's at 15. Hecla's no longer a 5-bagger, right? They're only maybe a 3-bagger. So instead of you getting 10x, you're only going to get 3x if you hold on to Hecla, right? Fortuna is the same. Fortuna, I think they're probably the best fit for you. So Fortuna comes in and makes an offer at 40% premium. They're probably only going to have 3x upside as well. So it'd be really, really nice if you could bring a strategic investor in there. And the way you could do that is basically bring in a strategic investor to pay for the CapEx. And when they pay for the CapEx, they basically buy 20% of your shares. And once they do that, you're over the hurdle. You got your 16% plus 20% takes you to 34. You're golden. You're like, this strategic investor, they're going to pay for my CapEx, and they're going to pay for a bunch of it by buying shares. Plus, they're going to back the loan. That would be
Sure.
the perfect scenario for me.
Sure. Yeah, and yeah, again, I concur 100% with what you said. I mean, from our perspective, look, right now we don't have a blocking stake. If somebody wanted to go hostile, they would have to do that without the benefit of any of our data, the private data. And so I think right now we have a number of CAs in place. All of these companies have signed confidentiality agreements, have agreed to a standstill clause, and so they cannot use that our data room and make a hostile. I mean, then they're in direct violation of the agreement that we have in place there. And so, yeah, no, I'd say strategic investor at the right time would make sense. But again, right now, that's not the focus. We're looking to minimize dilution, for any investor, bringing on a strategic investor as well at the current price levels. And so we're just conserving cash here, continue to de-risk this, coming out with the pre-feasibility study shortly in terms of the heap leach test work. Again, that could be very positive, coming out with that shortly, and then drilling some of these other zones here, doing that very systematically to continue to conserve cash here as long as we can. And then, yeah, under better market environment, we could look to bring in a strategic or, do a financing, bring in a 10% shareholder, something of that nature. And then again, that gives us the optionality to become more aggressive on the exploration side. And then eventually, again, when we're looking to make a construction decision here, there's a path forward as we could scale this up over time.
Okay. I have one final question, and I want to thank you in advance for being on and answering all of our questions. I think you've done a really good job explaining exactly what you have and where you're going. So my final question is this, is that my understanding is you haven't built or operated a mine. So are you going to step aside with a new CEO to build and operate the mine?
No, yeah, you would. I mean, obviously, we'll see. I have no idea. But right now, there's 4 different mines being built within a 30-kilometer radius for us. And what's really unique here, I mean, what other project has 4 mines being built within 30 kilometers of them? I think that's pretty unique. Now, what's great here in terms of timing wise, again, we could have a construction decision by, say, end of 2025, end of next year. All 4 of these mines will have just been built. And so there's teams that will be available. They'll be out of work. Obviously, they build the mine here. The construction teams will be available with direct experience. You literally just move, a couple minutes drive down the road, and then you're at Diablilos. And so there are teams in place. Now, we would, of course, hire a COO. We would, of course, hire, more, a management team focused more on the project development side, which we don't have now. We have a low burn rate. We're focused on exploration. So we would make significant changes to management, continue to bolster management's bench strength. But then there's immediate availability here of entire teams that will be available with direct experience building these. So yeah, no, we don't see that as an issue. I mean, ultimately, if I need to step aside, I'd do so. But yeah, I don't see why that would need to be the case. I think we have a strong management team, a strong board as needed. But yeah, we can continue to bolster that as required.
So you're excited. You're ready to build yourself personally. You want to stay on as CEO. You want to build and operate this mine. You're ready for that challenge.
If needed, yeah. That's not the immediate. The immediate priority is pre-fees, bankable fees, get the permit. We have a long road ahead of us, and so I'm not focused on building right now. But yeah, my focus is on maximizing shareholder returns, and I have every incentive to do that. And so, yeah, I'm happy to lead this team as long as needed. And, if there's somebody better who can come in, do a better job of maximizing shareholder returns, then we can have those discussions. But yeah, there's absolutely nothing stopping us from, getting to that stage down the road.
Well, I like your company a lot better after this presentation.
Thank you. Oh, I appreciate that. And yeah, thanks, Don. Thanks, John. Thanks very much for inviting me. Happy to clarify here. And yeah, no, I think this is a project that's grown significantly over the last several years. We still have a long road ahead of us here, but a number of really important milestones, catalysts coming up. So yeah, continue to look out for the news flow as we continue to advance this.
Excellent.
Great, John. Well, thanks a lot for sharing everything
Thank
with
you.
us. And yeah, we'll love to do a follow-up with you down the road.
Perfect. Okay. Thanks.
Thank you.
Thanks, guys.
Thank you.
I'll drop off. Okay.
Okay. Bye now.
Take care.
So, Don, you want to start on the evaluation?
Yeah, that was really, really exciting. I mean, he said all the right things. I mean, again, I wish their guidance was a little clearer. I mean, they do have the map, but it's not, most companies that are planning to build a mine, they take it all the way to, construction,
Right.
build first, the whole deal. And they're excited about what they're going to do. They're excited about their opportunity, their plan. I wish he had a little bit more passion about what he has. I mean, if they can get it to 15 million, if they do 9,000 tons per day at 15 million, I mean, we're talking about a $4 billion company,
That's
right?
a monster.
So $4 billion, and they're currently at 130. I mean, geez, I mean, the upside is just absolutely huge, right? And
Right.
I don't feel that passion coming off him. I wish I did. And the other thing, these are the only two red flags. But on the whole, this project doesn't really have any, especially with Milei now as the president of Argentina, makes it a lot better.
Yes.
The insider problem, I think that is a serious issue. I don't think they'll be able to get to first pour. I just never seen it. Have you seen a project like this make it to first pour that didn't have insiders? I can't recall one.
It's definitely a valid point. I was going to ask, just in the interest of time, I didn't. Just what were those institutions? Because then you and I could kind of know, right? If it's like a BlackRock, they have no freaking clue. Honestly, I worked there. They're the number one asset manager in the world, but they don't understand mining. Sorry, right? Like you need someone like a private equity shop that's got the long view.
Yes.
Right. And I think that's what I like about John is that John looks like a private equity guy. He talks like a private equity guy. That's different for me. I understand what you're saying, but I do think that he is a good leader in that way because he can attract capital. I look for that in management. A lot of the people that I met with just at Vancouver's VRIC last week are not as sharp as John. I met with over 25 CEOs in 3 days. And so that the passion is one thing perhaps, but the ability to present the story is another, and I think you were impressed, right? I mean, so it's like, if you're impressed, imagine what, some other clients with money sitting around will feel like that have way less experience than you do. So it's like, I think John's got that ability to lead. And I do agree with you on that slide that shows that arrow to 2024. They need to expand that into 25, 26
Yes.
to give us, as investors, a little bit better understanding of where that's going to land. I hope they'll do that after the PFS, which probably is just a matter of weeks away.
I think the PFS is going to be really strong.
Yep. The one negative possibly is the CapEx. I mean, he hinted at 350. Obviously, we've seen other PFSs starting with Argonaut back a few years ago that just, really started to get people to worry a little bit about how they're going to get there. But again, a lot of that fear is subdued when you have someone like an Eric Sprott with 12%, maybe he goes to 15 or even 19.9 down the road, depending on the quality of that PFS.
Yeah, that's true. Yeah, the PFS might attract a strategic investor. So, but I like it a lot better.
I'm seeing Eric do that a lot, aren't you? Like he's taking that 9.9 and going to 10
Yes,
to 12
when
to
he
15 now.
Yeah.
Rob McEwen doing the same thing, like with a couple of my holdings, he's going from 2 to 4 to 6%. I
Oh
mean,
yeah, speaking of
we
Rob,
need more guys like
yeah,
Eric and Rob, obviously.
speaking of Rob McEwen, I mean, McEwen Mining, they need a flagship project. This is it.
Hmm.
And he knows Argentina. They know Argentina well.
They do.
So
Yeah.
they could come down here and build this mine easily. So that would perfect fit for McEwen Mining.
Yeah. And I think it's good we do touch on Argentina, because obviously it was not a good jurisdiction for many, many years. And now with this change in power, I don't see how it's a negative. I think it's a positive, like John was pointing out, just like we're seeing in Peru, right? Castillo gets jailed, what is that, 14 months ago. Yet Peruvian stocks haven't really rebounded yet, with the exception of Buenaventura and a few others. I mean, there's still a lot of upside in Peruvian silver stocks, or just
Yes.
mining stocks in general.
Hochschild, yeah, Hochschild, I think looks really cheap.
Mm-hmm.
Yeah, I was actually pessimistic. I'm glad we had this talk with them. I was actually very down on Abra, because I just thought last time I spoke to them, I just got the feeling they just wanted to drill and sell, but they've obviously pivoted towards development.
Mm-hmm.
So,
Agreed.
okay.
Well, good to see you, Don.
Till next time.
Yes, we'll have Barton Gold on in February, and look forward to seeing you when you're out here in Arizona.
Very good, John. Yeah, I look forward to Barton. That'll be a really good one.
Yep.
Yeah,
Thanks for the idea.
That's a company I think that we're going to see more passion around development versus Abra. We'll really see the dichotomy about one company who's totally, bought into building a mine. This is what we're going to do, kind of thing, versus
right.
we're deciding if we're going to come to a construction decision. So it'll be an interesting difference. How people will get to see the difference, how I see them as well. Okay, John. Till next time.
Thanks, Don. Thanks, everyone, for tuning in. See you next month.